Hey everyone, in today's video, we're going to be talking about 10 Canadian stocks that are undervalued in my opinion. These stocks have relatively low price to earnings multiples given where the Canadian market's at, or at least the industry that they operate in is at. So we're going to go through each one of these stocks, talk about their dividend, talk about their price to earnings ratio. We're going to go over some investor presentation slides as well on some of them, just to give some more background on what these companies do and how they're pacing. And then hopefully coming out of this video, there's one or two of these that you are unfamiliar with or that you add to your watch list or do some more research on if you're looking to add a low price to earnings ratio stock into your portfolio as well. Like always, if you like this kind of content, be sure to give this video a big thumbs up. Really helps with the YouTube channel. And if you haven't yet, be sure to subscribe to the channel as well. It really means a lot. So we're just going to jump into the first stock here. It is CIBC, Canadian Imperial Bank of Commerce. This one here, looking at it over the year, it's about flat year to date. Over the last 1 year, we're down 13%. Currently paying a dividend of 6.3% here, and we're really playing around 52-week lows of $53. We're at $55 right now, so a couple percent off the 52-week lows. This bank operates primarily in Canada. They have a big Canadian mortgage book, but just looking at their price to earnings ratio here, they're expected to do $6.75 both next year and this year, which puts this stock at about 8 times current year earnings. So you're getting 8 times earnings. So on a free cash flow yield, you're getting about 12%. You're getting half of it paid to you in a dividend. The other half is being invested in the business or could do mergers, acquisitions with it. So I think for a company that has had a really good long-term history of creating value, increasing their dividend year in and year out, this is a great time to be getting into Canadian banks. And this bank specifically is the cheapest out of the big 5 banks. So this is definitely one that I'm watching to potentially add a couple more shares of. And this one caught me a bit off guard, seeing how cheap it was. I thought it would be trading probably closer to 9 to 10. We're all the way down at an 8 times price to earnings ratio, both for this year and next year. Going into the second stock, it is Spin Master. So Spin Master is a toy company. Just taking a look at their chart here, down 22% in the last year, $3.6 billion company. Not exactly at the 52-week lows, but pretty close to it, $35. 52-week low is $30. And this company is a bit more fatty in nature, depending on what kind of products they're launching, if they have a trendy product or a product that is flying off the shelves for this specific holiday season or whatnot. So you can see it go up and down a lot, but generally it's been trending down over the last couple of years. Long term, it's been all the way up to $60 during the pandemic, went almost down to $10. So all over the place here. Looking at some more of their divisions, they play in toys, which is what they're most well known for. So operates toys in over 100 countries. You see some of the brands that they own here. Paw Patrol, super popular. They do a lot of puzzles. I think they bought the Rubik's Cube brand a few years ago as well for like $50 million. So they own those kinds of businesses. When you go into toy stores, a handful of the products and the brands will be theirs. They also have an entertainment business. So they have a studio that produces entertainment assets like shows and stuff like that across Paw Patrol and a number of these other brands here. And then lastly, what they're really investing in lately as a growth driver is digital gaming. So just to read off, Spin Master has established a presence in digital gaming anchored by the Sago Mini and Toca Boca brand, I'm sure I'm saying those wrong, which offer open-ended and creative game and educational play in digital environments. So if we look at their strategies across these 3 pillars of their business, it looks like this. So the toys are the kind of legacy business that's providing a ton of top line, bottom line, and free cash flow to the business. Entertainment builds the franchises. So this is really about brand building, and the better the entertainment is and the more people and children watching the entertainment, the more people that are going to go out and buy the toys. And then lastly, digital gaming is to leverage play-to-learn platforms using both new and existing IP. They're looking to deepen the ecosystem with the consumers. I was looking at one of the other slides here, just talking a bit more about the finances. So this is kind of the role here. I'd say digital games are more the long shot, or like the the area of the business that may grow fast, but it's pretty unprecedented. They don't really have a lot of history in it, so they see potential for high returns once games reach critical mass. So probably lots of capex out front, but if they blow up and they scale, there's opportunities for a lot of revenue and profitability. Grow digital games revenue to 20% of total revenue. So they want 20% of their revenue coming from that third division. Seems like it's smaller right now. And then accretive to overall Spin Master margins and focus on profitability. So you can kind of see they have it highlighted here. So it's definitely a focus and a growth driver of their overall business is this digital gaming franchise. But really, really right now, most of the profit and revenue is coming from those first two pillars. Looking at their earnings here, they're expected to do about $3 in 2024, currently traded at $35 a share. So trading at about 12 times next year's earnings. If you look at the high estimate, some analysts think they're going to do about $3.40, which would have them trading about 10 times next year's earnings. So kind of a low teens multiple on this company. And it's one of those companies that if they have a really good holiday season or they launch a really good product in time for Christmas, you could see this stock go up huge in a very short amount of time. So definitely an interesting play. Unlike lots of the other stocks, they don't have a big dividend, just 0.7%, but at least they're paying out something too. Going into stock number 3, and it is another bank actually. So EQ Bank is not a top 5 bank in Canada. I think they're more of a digital bank. And this bank has done tremendously over the last number of years. You can look here since they launched in 2018, stocks up over 100% over a time period that lots of the other banks have struggled. They don't really have a physical presence. They operate through their app. They offer high savings rates, and they continue to roll out more and more services. They expanded into Quebec last year. Looking at their PE, they have an 8 times PE trailing ratio. Their dividend yield's 2%, but they've actually been growing it like quarter over quarter. And if we look at their earnings per share estimate, almost $11 this year, which would get them to under a 7 times PE. Next year at $12, which would get them to about a 6 to 7 times PE. So super cheap valuation in terms of a multiple, especially for a company that's been growing their profitability at the level they have. You can see here a year ago they were at $9 a share. This year they're going to be at 11. The year after that they're going to be at 12. So they're growing way faster than the general Canadian bank market, yet they have a lower valuation. So this one is definitely an interesting bank stock, in my opinion, to keep an eye on. Going into the fourth stock here. So the fourth stock that's trading at a pretty cheap valuation, and some of these have reasons for its trading at cheap valuations, but it is Allied Properties. Allied Properties operates and owns office properties in major cities across Canada. You can see here they have a dividend yield of 8.6%. They pay out $1.80 a share. They make about $2.20 a share in funds from operations. So still has about a high 70s to 80% payout ratio. So for now, this 8.6% yield is safe. You can see here the stock has gone down from $30 to $20 in the last year, but it was a time that this stock was actually trading closer to $50. If I go past 5 years before the pandemic here, it was up here at $54, $55, and then you can see it's just never really recovered. It's obviously the combination of interest rates going up, general sentiment around financing and providing loans to office REITs just because of no bank wanting to be held with the bag if these properties end up getting devalued in a major way. And then also work from home, less tenants that are looking for physical office space, or at least as much physical office space as before. All of this is kind of hitting Allied at once. So looking at Allied over time here, you could see while they're hitting a bit of an inflection point where it's a lot of uncertainties in their market, over the last 20 years, they've done a really great job of increasing the net asset value per unit, which is the line here, going from $10 all the way up to $50. And the annual distribution, they pretty much increase it every single year, now to $1.80 in 2023, all the way up from $1.50 just 7-8 years ago, they've increased their dividend 20%, which isn't huge, but you got to remember that you're getting a really good and strong starting yield on this stock, in addition to the raises that they've been giving. In terms of some of the clients that they have here, you can kind of see some of their biggest tenants. You have Google there, you have Shopify, you have lots of other tech companies, Entertainment One in the entertainment space, National Bank. So lots of great businesses and companies. Just taking a look at like the type of assets that they own, you can kind of see the Well is one that they part own with Riocan and a third party. Just scrolling through here, so you can kind of get a sense that these assets, for the most part, are flagship assets. This is right in downtown Toronto, Adelaide and Duncan as an example. So these aren't like little dinky secondary, tertiary market office properties. These are really like state-of-the-art flagship office properties that really only like Fortune 100 companies, for the most part, would be interested in or would be looking to pay for this level of quality. So I do like the quality of the assets. And I do like the valuation. If we go back to the last slide, you'll see that their net asset value is still currently over 50. So the value of these assets and the value of the stock behind these assets is over half, or has been more than cut in half with the recent market sentiment and downtrend. Yet the earnings per share, the funds from operation, has remained the same as when the stock was over $50. So I get the concern, I get the risk, but I think it's a decent risk reward profile where it is. If interest rates start going down, once the market kind of normalizes on return to office and whatnot, I think the stock has the potential to really rebound in a big way. And in the meantime, I'm collecting that 8.5% starting yield. Going into the next stock here, this one is Northwest Healthcare. So Northwest Healthcare is, not Northwest Healthcare, Northwest Company. I own a separate company called Northwest Healthcare that hasn't been doing well, but Northwest Company is a retailer that operates mostly in northern Canada. Looking at their business over the last 5 years, up 20%. Last 1 year, up 7%. They also pay a really nice dividend here, about 4.5%. Looking at their business here, you can see kind of where they are located. So all over northern Canada, more like remote communities where it's not a lot of competition, challenging logistically to get products to. They also have some stores on islands and whatnot across Latin America, I guess that would be, and whatnot here, just a couple locations. But the predominant number of doors and profit and revenues coming from kind of these isolated communities across Canada. Looking at how they've done over the last 5 years, their sales continue to slowly tick up. So 2 billion to 2.1, 2.2, 2.3. EBITDA, same kind of line here. You can see a bit of a pop in the pandemic years, like lots of grocery chains saw, but it's normalized to a level that's still higher than it was before the pandemic, which is great to see. Dividend payout, on average, they've been increasing their dividend about 4% a year, but I love the consistency every single year increasing the dividend a bit. So you're getting that 4.5% starting yield, but you're also getting a raise. And then the return on equity, great return on equities, 20% plus over the last 5 years, every year. So that is a great sign that the money that they are making, that they're not paying out in dividend, they're investing it in a smart way and returning and creating future value, which is how they're increasing their dividend every year, how they're expanding their business and growing revenue and EBITDA. So it seems like they've been executing really well on this company here. Going into their earnings, they're expected to do $2.76. So they're trading about 13, 14 times next year's earnings. So definitely not as cheap as some of the other stocks we just looked at. Allied, for instance, at 220, funds from operations trading at about 9 times earnings. But they've had a lot of success lately. They're increasing their dividend every year. They have really high return on equity. So all of these factors give it a bit more of a premium. With that being said, for a company that has 20 to 30% return on equities, increasing their dividend every year, really strong moat in terms of the environment and the cities that they operate in, I think a 13 times future PE is very reasonable. So that's why it's on this list of undervalued stocks that I'm sharing. Going into the next stock, it is another grocery chain Empire Company. So Empire over the last year is about flat, pays a 2% dividend, $9 billion market cap, trading at a trailing PE of 14 times. A bit more about Empire. So those of you who may not be familiar with the corporate name Empire, this company owns Sobeys and then a bunch of other brands that Sobeys owns. So you have Safeway, you have Food Basics. Food Basics is maybe Metro actually. But you have Sobeys, you have Foodland, you have Farm Boy, you have Longo's. They just bought 50 or 51% there. You have Safeway out west. Their e-commerce businesses that they created, Voila, Thrifty Foods. I wasn't familiar that they owned that. Maybe they acquired it. Freshco is their discount banner, not Food Basics. So they have a ton of different banners across their business that you're probably familiar with, at least a couple of them there. Going into their business, so 1,600 plus stores in total. They do a ton of sales, obviously, just with really low margins, as is normal in the grocery industry. 28 distribution centers, 51% interest in Longo's, 90% give or take in Farm Boy that they recently acquired. And then another element of this business that I really like is they own 40% in Crombie. So Crombie REIT is a retail REIT. Just to find it here quickly. I hate how they only show the U.S. ones on the REITs for some reason. $1.5 billion. So they own 40%. So they own about $700 million in Crombie REIT stock. So almost 10% of their value is in a REIT essentially. And that REIT's paying them like 5-6% a year, which is, at that level, they're getting millions of dollars a month in dividends just from owning shares in that REIT that they can then deploy for their dividend or deploy in other investments that they are making. You can kind of see here the stock price from 17 to 23 used to be about a $20 stock, hit 40, but has recently recovered back down or went back down closer to $35 a share. All in all, still really good performance, at least in the medium term here for the company. This is their presence here. So they have a ton of presence in Quebec, 700 doors, Atlantic Canada, 500. Ontario, they're actually pretty underdeveloped in Ontario. I assume that's because Loblaw has a really big presence here. And then out west, 426. So they actually have more in the west, more in Quebec, more in Atlantic than Ontario, which is interesting to see. You can see the growth rates they've had here as well. So BC grew 8% in population, Alberta 8%, Ontario 8%, Quebec 5%, Atlantic 6%. So nothing too notable in terms of differences across the board there. And then just their actual scorecard and metrics here. So sales up 4% CAGR over the last 6 years, adjusted EBITDA up pretty big, 20%, but who knows if there was an issue in the base or whatnot. That seems like a really high EBITDA CAGR for 4% revenue growth. And then EPS CAGR, this is really impressive. They were making under $1 a share back in 2017. Now they're making almost $3 a share for two back-to-back consecutive years here. So that's really great to see. And then just on that $2.80 a share, that means that at $35, this company is currently trading at about 13-ish times current year earnings, and I believe it was closer to 12 times next year's earnings. So similar to Northwest, it's trading a bit cheaper than Northwest, but has a bit more competition in the markets that they play in. So I think it makes sense. But they are doing a lot of things. They do own a portion of the Scene loyalty program and other banking initiatives, as well as investing heavily in online delivery and whatnot through Voila. So they're using lots of that cash. They're only giving you 2% of it back. They're using the rest of it to do all these other initiatives and investments. And I believe they've also been buying back some shares too, which is great as a shareholder. Okay, going into the next one here. The next one I'm talking about is Parkland. So Parkland Corp primarily owns a lot of gas stations in and around Canada. You see here up 25% in the last year. Over the last 5 years, though, they're actually down. They pay about a 3.5% dividend yield here, just so you can see some of the brands that they own. On the right-hand side, they own the Canadian rights to lots of these oil company gas stations. So Ultramar, Pioneer, Chevron. They recently bought M&M Food Market for about $300 million as they've looked to push harder into, one, diversifying their business, but also providing fresh food options and different alternatives for the convenience stores attached to their gas stations. That's been a big profit driver for them. Obviously, gas is really low margin. Looking at their dividend per share, and you may think, how as a gas company, and gas is becoming less and less prevalent in cars, more people are using EVs and whatnot, but how are they able to continue to perform really well? Look at their dividend payout that they've been giving over the last 10 years. Every single year they've done, while small raises, they've been able to maintain how much they pay out and then give pretty decent inflation adjusted raises all the way from, if I go to 2015, they're doing $1.08 share. Now they're doing $1.36 share. So about 30% jump in the last 8 years, which is pretty good for a company that has a starting yield already of 3.5% to start. Looking at their total earnings per share, it's about $3.30 for next year. So they're trading at about 12 or 13 times next year's earnings on this one to get exposure to all of those gas stations, as well as the retail operations that come with it, which is really one of the areas that they've been betting big in. They're calling out adjusted EBITDA of about $2 billion, and their market cap is about $7 billion. So obviously in a business like this, there's lots of depreciation, lots of stuff like that. But the amount of cash flow that they're spitting out on a quarterly and annual basis is huge for the amount of market cap that this company currently has, making it an interesting potential value play to consider. The next stock is another REIT. It is Riocan REIT. So Riocan, I'm going to do about $1.80 in funds from operations this year, trading at $19.80. So right around 11 times earnings here. This is one of the biggest retail REITs in Canada. I think they may be the biggest retail only REIT actually. So you can kind of see here their target and then their estimate in terms of so far in 2023. So their target is, or their performance so far in 2023, that's about half done. You can see their target is to do about $1.80 in EPS, and they reaffirmed that they're on track. They've done about 90 cents in the first 6 months, so they should be good. Their NOI growth's actually been exceeding the target so far, so it'll be really interesting to see if this continues to progress over the second half of the year, and if that actually drives FFO per unit to be above the $1.80. Development spend has been pretty in line with what they were expecting, about $400 million on the whole year, and funds from operation payout ratio around 60%, which is leaving a lot of capital to invest to grow NOI and in other ways, whether that's share buybacks or repaying debt or whatnot in the year to come. Okay, going over into stock number 9. It is Cargojet. So Cargojet is a logistics transportation company moving goods around via plane. In the last year, the stock has crashed 20%. Similar to some of the sentiment around the rails, just less people moving goods around. It seems like more money being spent on services, experiences, travel in this economy rather than goods. So I'm sure, or not sure, but it may rebound, but you can kind of see over the last year or 2 years it kind of trend down after trending up huge during the pandemic, up here 100% from pre-pandemic to peak here. So there is just a bit of a correction going on. Looking at their EPS estimate's about $4.70 for next year. So this one trading right around a 20 times earnings. But this one in the past used to trade super expensive as they just fit a really big niche that was needed and not lots of competition in this space, at least in Canada, given where their routes were and where they were going. They also have been growing really fast longer term as well, as you can kind of see by this chart. So this is one that while it's at 20 times earnings, it is way off of its 52-week highs, closer to the 52-week lows. And they've had really good long-term performance, even though they're having a bit of a demand blip right now for their services. So I thought I'd add it on the list. And when we're talking about airplanes and air transportation, the last stock I have here is number 10 is Air Canada, trading at about $20 a share. Looking at their earnings per share here. Expected to do $3.70 this year, $3.80 next year. So at $3.70, if I multiply that by 6, it's trading for six times earnings would be more than what the current company is trading for. So it's trading between 5 and 6 times earnings right now, paying down huge amounts of debts on their balance sheet. Obviously, long term, this company has not come close to recovering from the pandemic, but they used to trade at like a 7, 8, 9 times multiple. They're really deleveraging quick to get back to where they were from a debt ratio as before the pandemic. So I think their multiple can expand here from 5.5 times to 7 to 8 times really quickly, which if it does would get this stock closer to $30, $35 a share perhaps. So going to be really interesting to see how this one plays out. In recent weeks, I think the stock has gone down about 10% behind some sentiment in the US around airlines calling out that they're going to have some profit hurts versus their initial profit forecast based off of costs going up and whatnot. And obviously, it just makes sense that that would also pertain to the Canadian airlines as well. So people are trading down Air Canada as a result of that sentiment and those comments that were made. So it'll be interesting to see how it actualizes in Canada. There are also some fear that this past kind of year of travel from a cost perspective was really a peak in terms of how much people are willing to pay and how many people are going to be traveling, just because of the fact that the market or the world was harder to travel in the couple years prior. So there was some built up demand. And if that will kind of normalize as well, is another concern going into next year in 2025. So we'll see how it goes. Ultimately, I think it's a great thing for these airlines that they're making tons of money hand over fist right now, so they can really repay all those debts that they took out during the pandemic and get back to operations like they were before the pandemic. But if they're going to be trading at significantly lower margin profiles or multiple profiles as they were before, could be a good long-term opportunity for some people to consider getting into. So those are 10 Canadian stocks that I'm considering to be somewhat undervalued in one way or another. Would love to hear from you guys in the comments if you guys own any of these stocks, or there's any other low price to earnings or relatively cheap stocks for their growth profile that you think exist in the Canadian market. Would love to hear from you in the comments, so just drop it down there for us to go down and look at. If you like this kind of content, be sure to subscribe to the channel. Give this video a big thumbs up. It really does help with the YouTube algorithm get these videos to more people. I really do appreciate it, and I will see you guys in the next one. Thanks.